Hello and welcome to another episode of Bidishanomics. I am Sabika Sayyad and with us Dr. Bidisha Bhattacharya, our consulting editor for economics, who takes your questions, dear members, on economy, India's position, geopolitics and how it's affecting our financial position. The first question is by Surbhi, one of our very loyal viewers and always sends one of the most incisive questions. Surbhi is asking, why do countries peg their currencies against the US dollar, despite knowing their economies are most vulnerable to dollar fluctuations? In the past, we've seen what had happened to Thailand, and still, why do countries continue to do it? Asking this in respect of the South Asian and South American and Latin American countries.
Very sharp question. Before we get to why Thailand did what they did, it's important to understand what does this word pegging actually mean.
Right.
So basically, a country decides that its currency will be fixed against a particular number of dollar, against any other currency, and it will keep it fixed, and it's usually the dollar, instead of kind of instead of the market moving in a stock market kind of a behavior,
Right.
up and down. Now, the government basically promises that 1 unit of our money will be worth this many dollars, and it will stick to it basically. And in order to defend it, as we have in earlier episodes, we have
Right.
discussed that it will sort of either sell or buy, at the foreign exchange market, to be specific, and sell their reserves. Now, why give up that control? There are primarily, or why not give up that control? There are primarily three reasons. The first being trust.
Hmm.
Now, when you peg your currency against the dollar, which is one of the most trusted currencies across the world, it kind of increases your credibility and your currency's credibility.
Hmm.
And especially in terms of, when investors, or in the view of investors, foreign investors, that overnight the value of my currency will not collapse.
Right.
Then comes the second reason, which is trade. Now, if you are an economy or a country that is highly dependent, import dependent, on the US in terms of trade, let's say, for instance, oil for that matter, that is denominated in dollars, no matter which country you are importing or trading with, then specifically it is always kind of useful and imperative in certain cases to peg your currency against the dollar. Then comes the third reason, which is taming inflation. Now, why am I giving this third reason to be specific? Because, the question specifically spoke about Latin American
Yep.
countries. Now, Latin American countries have had very, very painful episodes of hyperinflation in the past. There is a history, very painful history around it, which is when, after those history, or after those historical episodes, they either had to give up their currency and completely adopt the dollar and use the dollar as their currency, just in order to be able to establish trust and credibility and
Right.
stability again. So which is why they preferred, pegging the currency against the dollar. So, pegging is not necessarily naive. It comes, in the version of a trade-off. And why am I saying so? Before I tell you the story of Thailand, this comes from a very elegant idea in economics called the impossible trinity,
Okay.
or sometimes some economists call it trilemma. So the impossible trinity says that no country can have all three. Now, what are these all three? Number one is a fixed exchange rate. Number two is free movement of money in and out of the country. And the third is an independent monetary policy. What does an independent monetary policy mean? That the central bank of that country can change the interest rate as and when and how they require, depending on the domestic economy's need.
Right.
All three cannot happen at the same time, and if a country tries to forcefully follow all three and maintain all three in their economy, sometimes a crisis like situation may emerge. So a classic example of this, the best example of this, is Thailand. What did Thailand do throughout the 1990s is that it pegged the baht for 25 to the dollar.
Okay.
And at the same time, it was welcoming a lot of foreign investment for real estate boom, and that resulted in a lot of real estate boom during this entire period. However, by July 1997, what happened was the current account deficit of the Thailand's economy was expanding and it was widening and widening in a way that it started becoming very visible to all the other sort of bond markets, the other traders, the other investors for that matter, and the foreign exchange market as well. Basically, current account deficit is that it showed that Thailand was importing way more than it was exporting.
Right.
And as a result of which, now it's important to understand a current account deficit goes hand in hand with a currency depreciation. A current account surplus goes hand in hand with a currency appreciation.
Right.
Appreciation means the value of the currency increasing, depreciation means the value of the currency falling. Now, they noticed that this baht was overvalued because it was pegged at 25 to the dollar. As a result, what happened is the minute every other, other economies kind of notice that you are trying to defend your currency, they do something that is in economics or in finance, as we call it, the speculative attack.
Okay.
So the speculative attack is, selling a lot of their currencies in order to, so that this defense kind of falls or the currency collapses in the foreign exchange market. Now, of course, the central bank in Thailand had to defend what was happening, and they had to defend their peg. So what did they do? As every other central bank does, they started selling their foreign exchange reserves. They kept selling their foreign exchange reserves up till a point that in July to August 1997, they completely ran out of reserves. And it was around a $30 billion worth of reserves. It completely was washed away, wiped away. And that resulted in huge amount of defaults, which kind of slowly trickled down to Malaysia, to Indonesia, to South Korea, all these neighboring kind of countries, and resulted in something that we know as the Asian financial crisis. Right? Now comes to the next part of the question. Why do countries still peg today despite knowing what has happened so far? Here I would like to mention a couple of countries here. Let's say, for instance, Ecuador. Now, Ecuador or Panama, they fully adopted the dollar, especially because given the financial crisis or the kind of, devaluation that they had experienced of their own currencies, that kind of, in the way, that lost trust and stability and credibility, and as a result they completely adopted the dollar. Now that loses certain amount of independence that you have as an economy. Then comes, of course, hyperinflation aside, there are certain countries, for instance Bolivia, Honduras, that follow a crawling peg. Now, crawling peg is a fixed rate, but very gradually, also like a soft peg kind of a thing, which is, letting the currency kind of fluctuate a little bit within a small band, very similar to the managed float, but crawling peg is more slow, more gradual for that matter. Then comes in South Asia, it is worth clarifying that all the economies in South Asia, none of them really follow a very fixed hard peg. Taking even India's case, India follows a managed floating exchange rate regime, where basically we have a certain range, certain band within which the currency can float. And if there are sudden movements, serious kind of swings happening in the foreign exchange market, then the RBI intervenes and, starts defending the rupee by selling a certain amount of foreign exchange reserves, exactly what the RBI had done recently. And even after selling a good amount of its forex reserves, we still had 10 to 11 months of worth of imports in the forex reserves. So we were in a much safer position. Now coming to even in South Asia, if there are exceptions, or rather, let's say, instances of hard peg, there's Nepal, there's Bhutan. They kind of follow a hard peg, but not against the dollar, against the rupee. And for the same reason, for these, for the credibility, for the trust factor, to be specific. So it's not that, this is kind of a naive decision that countries take. Sometimes adopting a fixed peg seems like the right option in order to garner more investment, in order to sort of make sure that infrastructure is being looked into. And sometimes it also looks as a safer option compared to, moving completely, either adopting the dollar as their own currency or completely moving into freely floating exchange rate regime. In earlier episodes, we have also spoken about capital account convertibility, why emerging economies don't really allow full capital account convertibility. That also plays an important role here. So that would be my answer.
Right. Bidisha, the next question is by Saito, and please do share your names. We'd love to know you by your name. You send such incisive questions. They're asking, what do you think about land value capture potential for Indian infrastructure? I'm thinking what they've done with NSP Pink Line station, scaled up for every single major railway station junction in India. Commercial space, agglomeration, jobs, infrastructure makes its own revenue.
Um, Very interesting question, and this kind of goes in the heart of agglomeration economies. The viewer also mentioned agglomeration. I'll get to that. But specifically, let's first understand what this land value capture is all about. So what happens is every time a metro station or a railway station is built, automatically the economy around it or the area around it starts
Gross.
developing.
Yeah.
Businesses start coming up, small shops start coming up, and as a result of which the entire sort of value of that particular land around the railway station or the metro station kind of builds. So that jump in value is of course very interesting, but somehow when that value increases, private landowners and private kind of entrepreneurs seem to enjoy that profit and that gain, and less of that gain is enjoyed by the government, who has built or financed that railway infrastructure or the metro infrastructure in the first place. So this is where the land value capture comes into the picture, where through certain developmental rights, through certain developmental contracts, the government tries to take or capture certain amount of value from this increased value of that particular area, around that metro station or railway station. So and now I was talking about, as I was speaking about, the viewers saying agglomeration. Now
Yeah.
what are agglomeration economies? It's imperative to understand this. Now agglomeration economies basically means that there are multiple businesses, multiple startups, kind of there are certain World Trade Centers that you have around, or multiple kind of shops that start working, operating together in a particular piece of land. Now what that happens is that automatically not just increases the price value or the monetary value of the economy, of that particular area, but also from an economic value perspective, it also reduces the cost. I'll
Yeah.
just give you a very brief example. First, let's say hiring cost. For instance, there are a couple of companies that are now probably buzzing around that particular metro station or railway station. Now what happens at that instance is, so say for instance there is an employee who has put their papers in a particular company, and there are other companies around where other employees are looking for a job change, and it gets very easy for the HR team there to kind of look out for employees around. There are also a lot of idea exchange that takes
Right.
place. The knowledge increases when there are multiple companies or multiple offices that are working around. Also it comes to when you'll see there are a couple of companies that are growing up, a couple of businesses, you'll see printing shops, small
Yeah.
retail shops, retail stores that are coming up, some basic kirana stores as well for that matter. So even that economic value starts buzzing, and that also reduces their cost, the company's cost for that matter. So this is the benefit of the agglomeration economy. Slowly you start seeing medicine shops, different kind of the needs that an employee might have on a day to day basis. So this is where agglomeration functions. Now is there an example, is there a possibility of something like that, where even the private enterprise comes into the picture, but the government also gains from it? Yes, there has been a beautiful example of this, which is done by Hong Kong.
Okay.
Now what the government at Hong Kong has done, and they have built one of the best, most efficient metro systems in the world.
Okay.
What they do is they kind of give the contract of a particular land, a land where to this company called MTR, so who build the railway infrastructure or the metro system or the railway system in that particular land, and of course that company buys that land. Now the responsibility of MTR, to be specific, is to develop or increase the value of that particular land, not just the railway system. Now what happens in that process is they MTR obviously buys that land at lower value, much lower value. However, because I mean, compared to once the railway system is in place, the value will be increasing. Now, what happens is then they start their bidding processes,
Okay.
where different these businesses, certain retail stores, certain different kind of companies or stores or shops, they come and they bid for certain sections of that land, and automatically there's an overall development that takes place. And there have been surveys, there have been data that have shown that the amount of revenue, the amount of income that MTR has earned is 3 times more than what it has earned from the train fares, to be specific.
Okay.
So what happens that in that process, of course, I mean, then once the businesses, the shops, everything is in place, MTR will take probably a particular share of their profits, or own some small stores there, apart from this railway system. Now, this has worked beautifully. Can this work in India? There has been an endeavor that has taken place back, for years it was being done, and now a more advanced version is coming up or is being discussed, which is, there is one particular caveat that I would like to mention. Of course, every wonderful result has also a downside to it. There are times when this MTR in Hong Kong has also experienced profit losses, or sort of revenue kind of losses.
Okay.
It has happened in 2023 because of certain property values going down. So
Okay.
as a result, their income, there was a drop in their income or earnings by 21%. So there are times when these vulnerabilities and volatilities do exist, but overall Hong Kong kind of generated and created a very, very efficient system out of this. Now, coming to, has India ever tried? India has tried this, and it is called the Amrit Bharat Station Scheme.
Okay.
So this was a redevelopment push around for 1,300 stations nationwide, and to an extent it worked, to an extent it did not work. There were private enterprises that did not show a lot of interest in them. There were multiple reasons that were flagged, that this kind of, in 2022, in fact, the government rolled back this particular scheme. And what was the reason for it? I personally feel, as an economist, the reason might have been, private enterprises not showing interest, etc., etc. But according to me, the reason is land. So what happens with us is, in Hong Kong, government has clean ownership of particular land, clean land records, so that if it has to give it away to an enterprise or a company or a business like an MTR, there are no sort of structural delays that are involved. And
Yeah.
in the previous episode itself of Bidishanomics, we spoke about how much we require land reforms. What happened here was, every time the Indian government tried to follow this particular scheme or follow this particular process, there are land records that are not even available. Nobody even knows who owns what land, and there have been multiple disputes associated with multiple lands. So which is why this particular scheme, I feel that there is high time that we first get the land reform sorted, and then
Yeah.
automatically these things will follow. Definitely now, when it comes to building metro stations on railway stations, the budget allocated has increased. Back in 2023, 2024, it was approximately probably 3,500 to 4,500 crore. Now it has increased to 15,000 crore.
Right.
So that allocation has increased because the government is now themselves completely trying to rebuild. And of course, there are wonderful results for it, as you can see in Netaji Subhash Place.
Yeah.
There are multiple other instances of that sort as well. But I feel the first and foremost thing that needs to be done by the Indian government is land reforms.
Right.
And to make sure that we have clean, proper recorded, with proper records land, that can be sort of taken up by certain private businesses, and then they can go ahead with redevelopment, or with coming up with businesses, bidding it to different businesses, to different retail stores, to different companies, to different healthcare centers as well, for that matter.
Yeah. Vidisha, the next question is by Narendra Arya, quite a detailed question. He's asking, post independence, India had considerable industrial base: tea, textile, jute, automobile, iron, and steel. So many industries were there, all with a lot of employees with a knowledge curve. They could have modernized.
Yeah.
But government with Inspector Raj, License Raj, trade unions, labor laws, everything were against the industrialists. All industries had a slow death. Now we have been cursed with a low industrial base. Even today, politicians curse Ambani Adani. Will this mindset ever make our country industrial? No wonder countries with no economy now have a very strong industry, and we with a large market have poverty and unemployment unresolved.
Wonderful question. I'll take it in parts. First, because I feel there's one part that's very, very true about the license Raj, Inspector Raj. And then there's definitely another part that needs us to delve a little deeper.
Deeper.
The no economy part that was mentioned,
Yeah.
countries with no economy are doing so well right now. So first, let's talk about, just after independence, you're absolutely right. We had all the necessary inputs to become an industrial giant, be it the tea and coffee sector, or cotton for that matter, jute mills even. But however, after that, with the license Raj coming into the picture, the license Raj, just to give you a very brief idea, during the period of license Raj, businesses had to seek permission from the government for every single thing. Even if you had to break down a door or create another extra commodity, in your factory, you had to seek permission. Then on top of it was layered by Inspector Raj. So now Inspector Raj specifically, what they did is they kind of created this maze of regulatory standards that was very difficult to comprehend by companies.
Right.
As a result of which, what we saw, that there was a very, very fast decline in industrialization or new businesses coming up for that matter. Now, what we noticed in 1991, to be specific, even after the license Raj was removed, there are multiple studies of that kind, by Agion, by different other researchers for that matter, across the world, across countries, who have said that after the removal of license Raj, or states that were the first ones to remove these tighter regulations and increase employee flexibility, employment flexibility for that matter, worker flexibility, removing too many labor restrictions, kind of started doing much better in businesses, in growth. And we have extensively discussed about this, going state by state earlier. However, what happened after 1991, with this severe balance of payments crisis, that after the reforms and after the removal of license Raj, there was huge amount of growth that we experienced. But just like many macro numbers, you don't get to see what's happening in the micro picture. So if we delve a little deeper, definitely after 1991 there was growth, but the manufacturing sector's share in the economy did not grow much. Which is something that we have spoken about earlier as premature deindustrialization. There are many other names that have been taken regarding this, but manufacturing share of growth remains stagnant. So removal of license Raj was not the only reason that led to growth, because what happens is when you don't increase the share of manufacturing sector, in an economy, because manufacturing is the only sector that can create jobs at a scale that no other sector can. Right. For that matter, that kind of stayed as a gap during that time, and economists came up with this very interesting term, which was extensively used back then, which was jobless growth, which meant that growth is increasing, but there are not enough jobs that are being generated in the economy. Now, there is a very interesting bit that Narendra is pointing to, which is that the ones that had no economy are now industrial powerhouses. Now, he's likely talking about South Korea and Taiwan. Now, back in, let's say, 1957, if I take two countries, South Korea and Ghana, both of them had a very similar per capita income. However, by the 1990s, South Korea's per capita income was almost 10 times that of Ghana's. And what is exactly the gap between the no economies like South Korea and Taiwan and us? To understand this, it's important to understand the difference between import substitution and export oriented industrialization. Now, after independence, or after, let's say, the 1991 reforms, the growth that we saw, or what exactly India did, was import substitution. We were highly, highly protected of our economy. Now, India's post independence strategy was more of import substitution,
Right.
and less of export oriented industrialization, because post independence we had lost out on a lot of resources. So, the tendency was to be highly protective of the economy, to first produce for the domestic economy, for this, for the civilians, for people in the country, than being more competitive with the rest of the world. So this is where India did not really get the time, or did not kind of focus on being more competitive, increasing export oriented growth, producing commodities that would increase their exports for that matter, but they catered to feeding the people in the first place, and also rebuilding certain industries that were probably broken in the first place. On the other hand, South Korea or Taiwan, they kind of followed a mixed approach. Up till 1950s, even the later part of 1950s, they were also following import substitution, but then slowly they moved towards export-oriented industrialization, which is, as a result of which, their manufacturing sector kind of started booming, and that increased. One particular point that I would like to mention about South Korea, because it's very easy, and most people talk about, they had nothing and then suddenly now they are booming as an economy. That's not true. Up until the 1950s and 1960s, what South Korea was slowly doing is that their primary education was so strong that by the time they were ready to scale, they had a very strong chunk of human capital ready with them.
Right.
Very, very few economies, very, very few countries focus or invest as much on social sector, infrastructure, especially in education and healthcare, which South Korea did at one particular point. And that came to their rescue, or rather rescue se bhi zyada, I would say, that helped them fasten up the process of growth, and growth in industrialization, to be specific. Now coming to the Ambani Adani point, here I would like to talk about the two sides, of this debate. There's one side which is the crony capitalism debate, that because of these big giants or large entities, there are small entities that are not being able to compete, that are not being able to enter into the picture. On the other hand, there's another sector that says, and data backs it up though, that these large entities possess the right kind of infrastructure and scale to be able to expand into industries or areas that small industries or small entities don't. For instance, ports, highways, energy, telecom power for that matter. So I believe that a mix of both needs to exist for an economy to do really well, because large entities can actually pave the way, create that infrastructure where these small entities can enter into the picture, and then it can be a very kind of holistic approach towards industrialization.
Now, Bidisha, the last question for today is by Ranjit Pal. He's asking why inflation is not calculated in the retail stock of major places in major cities.
Very interesting question. Firstly, let's understand how is inflation really measured, at least in India. So the main number that you heard about in India is the consumer price index. And why I find this question very interesting, because this is something that all of us have experienced at some point or the other. You go to a mall in South Delhi or South Bombay, and you see the prices are so high, but the overall inflation number that you see in newspapers is very low. So now this consumer price index, let's first understand how the MOSPI, or Ministry of Statistics and Program Implementation, how do they collect the data. It's not really tracking one shop, one store, or one particular commodity. It's an average, and averages always hide extremes. So what does the government do? What does the Ministry of Statistics do? They take data, they create a particular sample where they go to a certain number of rural markets, a certain number of urban markets. As of today, the data that stands, every single month, government field officers, they officially go and collect the prices from 1,465 rural markets and 1,395 urban markets across the country. Now, how it actually works is that government field officers, they physically collect prices from a certain number of rural markets and certain number of urban markets. Now, as of today, the number stands at 1,465 rural markets and 1,395 urban markets, across the country. Now, this number has actually increased from around 1,181 rural markets and 1,114 urban markets, which was, the number under the old system. On top of that, the government has also started drawing information or taking information from 12 online digital marketplaces as well at the same time. Now, every one of those prices gets fed into the system. There are certain weightages that are given to every single commodity. Rice gets a particular weight, wheat gets a particular weight, any other food item also, spices gets a particular weight, and then accordingly that basket is made. Now the part is, now here's why this number might be feeling more disconnected so far. Now, up until now, which means up until the February a month of 2026, the basket that we had, or the prices that were being measured, was against the information or the data that was collected back in 2011 2012, and that was not updated so far. However, the problem with that is the prices or the survey that was collected in 2011 and 12, that gave a lot of weightage to food, approximately 46 to 47%. So the urban markets or the urban people, how they spend, what should be the prices, that was not really getting captured, because if we are living in the cities or the urban areas, you also give a lot of importance, a lot of weightage to housing, say for instance rent, electricity bills, water, sanitation, the other factors as well, where you have to pay bills which are not there really. A lot of weightage is not given in rural markets. So as a result of which, now the data has been updated, and the reference now has been updated from February 2026 onwards, which is 2023 and 2024 have been the reference years now. So here the weightage for food has been dropped from 47% to approximately 30, 31, 32%, and the weightage that is given to housing, which is electricity bills, rent, water bills for that matter, they have been increased. That weightage has been increased. So hence now it feels a little more, let's say, connected rather than disconnected. But still, as I would like to reiterate this again, that averages always hide extremes. It's not that the price that you see and what you have paid, that gets reflected. It's for instance, if you have purchased something which is extremely valuable, and so let's say that you have purchased something in a mall in South Mumbai, but at the same time, a particular price of a vegetable in a rural market, for that matter, both get clubbed into the CPI basket or this export basket, and as a result of which the weightages that you see are average weights. Hence it will not exactly reflect the price that you see in the retail store. So finally, to directly respond to Ranjit's question, it's not that big city retail prices are ignored. I mean, they are absolutely a part of the data collection, but it's important to understand we are not looking at a range, we are looking at an average CPI basket, an average price basket. Now the weightages that are given are much more realistic compared to our living standards and how we look at prices, and how we, especially from the urban perspective, than it was earlier. And hopefully the more data gets updated and faster, for instance, we don't have to wait for an entire decade for the data to get updated. We will understand, the weightages will change over time, even further. So yeah.
That brings us to the end of our episode today, Bidisha. Thank you so much for taking such incisive questions from our viewers. And honestly, these questions help us think about India in the everyday through a lens that we're possibly not looking through in the usual. So honestly, these conversations are very incisive and very make these conversations keep me curious as well, because I'm not a numbers person. Thank you so much for being with us. We'll be back again next week with another episode of Bidishanomics.